When they say, I want to sell my business now, that's okay, right? So we're going to help you every possible way we can to help you get maximum value for the business. But you're not in as strong as a position as that person who thought about it in advance.
All right, folks, thanks for joining today. I have a good friend, a growing friend, as we've moved closer here in the last few months, I guess, since we initially met, Joe Valley from Quiet Light. We're going to be talking today about mergers and acquisitions and getting to know you a little bit. Welcome to the call.
Thanks, man. Good to be here.
Thanks for coming on. So let's get down to it, and I'm going to talk a little bit about you. What are you seeing? It's a new year. Things are moving. What are you doing? In your area of focus, what are you moving in this year?
Yeah, we're just trying to keep up with the growth, to be honest with you, Neil. Last year, we doubled what we did in 2020 in terms of closed transactions. And Mark, my business partner, and I were looking this morning at 2019. We've quadrupled in size, revenue and total profit-wise since 2019, 3 years. So it would be wrong of me to give you a doomsday prediction that inflation's going to, hurt everybody's profits and therefore they're not going to sell their businesses because of fear of taxes and things of that nature. I think there's going to be continued growth. I think there's pain points, but when an entrepreneur is running a business and they're hit with all of these things that they were hit with in 2021, supply chain issues and all of that, it wears them out. It beats them down. And they are going to be emotionally toast, unfortunately, some of them, and still want to exit. So my prediction for 2022 is there's still going to be an increase in total transactions, people interested, just because this industry is growing, selling online businesses. And I think the valuations will continue to grow a little bit. I think they went up a lot in 2021. There was we had an average of 4.5 offers on every single listing. I don't think that'll hold through the end of 2022, but I think it'll, once we get through the first couple of weeks of January, we'll see, things very much like 2021. I think maybe the fourth quarter of 2022 is going to be a little interesting. Predictions with the stock market. I think people are going to be focused on other things. If we don't have any major COVID shutdowns and another new variant, things of that nature, I think it's going to be another strong year for people that are running online businesses, people that are selling online businesses, and everybody in between.
See, that's very good because it's kind of what I think too. There's always, opportunities in when there's blood in the street, right? And we're kind of seeing a little bit of that. It's going to be the strong are going to rise, I think, through the coming quarters. And it sounds like you're feeling sort of the same way. So give us some background as to where you come to that conjecture. Obviously, you said, 3 years of growth, you've quadrupled, but you obviously have been in this industry for what leads you to come to that conclusion from your experience and your background?
In other words, who the hell am I and what right do I have to say that?
That's right. How dare you? No.
Look, I've been self-employed since 1997. I've built, bought, sold over a half dozen of my own online businesses. I joined a company called Quiet Light Brokerage after selling my last e-commerce business through Quiet Light. And at the time, it was Mark, the original founder, who's now my business partner, and Jason, who was my advisor at the time. Now we've got a team of about 35 people, all in, 15 of those being entrepreneurs turned advisors, meaning they're brokers, but they need to have built, bought, and sold their own online business first. And we've just grown tremendously over the years. Personally, I've sold about 100 million in total online transactions, touched another $500 million through the team at Quiet Light. And that number is going to go up dramatically because we closed 250 million in transactions in 2021. So we will surpass $1 billion in transactions in the next 18 months, I think.
So you have some history to speak against, which is a little bit. Okay. So in terms of the listings and stuff, as you mentioned, there's a lot of online. And is most of your portfolio online? Do you do any offline as well?
100% online.
100%
we don't
online.
touch any brick and mortar business.
And which of those kinds of transitions, e-com, which versions of those listings are you seeing the most of that's pushing that growth forward?
As our company, probably 65% of total transactions are e-commerce related, meaning there's a physical product. And then of that 65%, about 60% are, with the majority of the revenue being FBA businesses, Amazon businesses. The balanced SaaS content.
Balanced SaaS content. Okay, so that's good to know. So the majority of it is around Amazon FBA. That's what I understood, but I wanted to get clarity here as we
go. E-commerce and then, A
combination of a single channel Amazon FBA or multi-channel?
Almost everyone has at least some revenue from another channel, but when it's 80% Amazon, I call it an Amazon business.
80% Amazon, and then by that, you would almost break some component of that 20% into another website, channel, wholesale, retail, distribution, some kind of other method.
Exactly. There's all sorts of different channels. It could be a combination of their own website, selling wholesale, or whatever the case might be. But if it's 80% of their revenues coming from Amazon, in my opinion, that's an Amazon business. And my opinion is what the buyers say.
Well, and it's a strong channel of that business that it makes up. As you mentioned, the secondary channels don't have as much revenue, so it's considered predominantly an Amazon business, especially in my experience. Of those other channels, what are you seeing? Is it their other website? What adds to the additional valuation, the additional points you can put onto that business for an Amazon FBA? Is it the distribution? Like, what are you looking at in terms of your analysis? Is it having a Shopify store with some traffic and branding? Like, where do you see the next point coming from that makes that FBA business, instead of maybe worth 3 points, 3.2 or 3.5?
Well, it's not necessarily, if it's 80%, it's an Amazon business in my view. And then when you're drilling down into any business, whether it's 100% Shopify, 100% Amazon, a SaaS content site, whatever it might be, you're really breaking things down into risk, growth, transferability, and documentation. And risk is, is it a single SKU brand, right? And are you selling, one pet supplement and all of your revenue comes from that single SKU? Or do you have 14 different SKUs and the revenue from the biggest one is only 17% of your total revenues, right? Which one is riskier? That single SKU. So the higher the risk, the lower the multiple. And that's just one component of it. And then you get into age, defensibility, all sorts of different things in the risk category before you even look at, growth line trends, growth opportunities, built-in past growth. But where most people stumble, Neil, is actually on documentation. They don't actually have good, clear financials.
Yeah, financials, absolutely. It's one of the things we make sure people know from the very beginning. We set them up with a book of accounting, of a chart of records. We set them up with accountants and bookkeepers right from the very beginning, starting with the end in mind. That's one of the things we focus on a lot, because I know that's very important at that exit, because so many things are like, here's my receipts, here's my paper, here's my yellow book of business. And it's a very frustrating process for most people who don't realize what the exit looks like. So let's talk about that for just a second. If someone's coming in and that's the biggest problem, and I want to go back to risk here in just a minute, but I want to finish this thought through with you. And they come to you at the end. What are you going to see typically from that person who wants to sell that business? And what kind of pointers can you give? Obviously, the manila envelope we talked about. What could you give to them to kind of prepare some minds for the possibility of exit?
So if somebody's coming in, they say, look, I want to sell my business in 12 months. That's a great situation. When they say, I want to sell my business now, that's okay, right? So we're going to help you every possible way we can to help you get maximum value for the business. But you're not in as strong as a position as that person who thought about it in advance. Because we're going to look at your P&L and we're going to ask a question. First, do you have a P&L? Can you export it from QuickBooks or Xero with a monthly view? Second, do you do accrual accounting or you're on a cash basis? We want accrual accounting. If they're on cash, we've got to find a way to help them with their e-commerce bookkeeper to flip it to cash. Flip it to accrual, or we do it with them manually, which brings some risk component to it. And so it's got to be fully disclosed. And the numbers might not be perfect, and we disclose that to the buyers. But we're going to drill down into their P&L and make sure that we're capturing first every possible add back that is a legitimate add back, right? People don't know what an add back is. It's an owner benefit or a one-time expense that doesn't carry forward to the new owner of the business. A classic example that is 85% of the time not on a profit and loss statement is cash back money or reward points. People usually put that over to their personal account and think that's a great perk for the business. It's an owner benefit, and therefore it's an add back. I was at a e-commerce fuel 8-figure event in October, about 25 or 30 of us, and I'm sitting around the fire pit with one of the guys that's doing $50 million a year in revenue. He's got an offer on his business for 10 times, and he's picking my brain. I said, well, what kind of add back schedule did you do? And he kind of had a blank look on his face. I said, all right, do you get any cash back money from your business? He goes, oh yeah. And then he got all excited. He's like, absolutely. We actually do credit card stacking. We spend all of the money up to a certain limit, and then we go to the next credit card and the next credit card. Joe, we get $50,000 a month in cash back. I was like, okay, what do you do with it? He goes, it's over my personal account. My wife and I enjoy that money. It's $600,000 a year. Like, okay, that's an owner benefit. It should be an add back. He's like, but Joe, I have a 10-time offer. I'm like, yes, that's $6 million that you did not account for. So you're losing $6 million if you don't do an add back. That's just one example. You can add or subtract zeros as much as you want.
But how do you think he came to that conclusion? Was that listening to somebody else on a podcast? Or was it just lack of knowledge or lack of financial knowledge, lack of financial?
Look, he knows what he does. He knows how to run his business. He's an expert at what he does, but he doesn't know what I do, right? I can't do what he's doing. And without the experience that I have, he can't do what I do. So that's why we have those conversations. That's why we go to those events. We help people. There wasn't a fee for it. He bought me a beer, but that was about it. And that's why I wrote the book.
You're telling me you're cheap. Okay, guys, just buy Joe a beer.
Buy me dinner someday.
Buy your dinner. Sure. Okay, I'll buy dinner. Okay. All right, we'll make a dinner and a beer. How about that? That's good. But let's go back to that risk component a minute, because that kind of bullet points some of the things we know have to be addressed. And let's kind of break it. Risk, obviously, upside and potential, operational independence, and of course, documentation. Big factors in whether or not. So let's go to the risk component of that for just a second, because I had made a bold prediction on my Facebook the other day, and we're going to find out if I'm right. And that is that the decline of Amazon aggregators is coming. I don't know what your opinion of this is, and I see this as part of the risk, and I'm kind of transitioning this conversation a little bit towards that risk because of what I see, is that the lack of operators in the space is going to force them into some really tough decisions in the coming year without enough people to actually be a significant operator. You just did, said this gentleman, an amazing operator of the business who's lacking some of that knowledge, wisdom, and stuff that you can get them on the financial side. What do you see, in terms of that exit risk, operational risk, even touching on some of the Amazon aggregator side?
As far as the Amazon aggregators and the decline of them, I think it's inevitable, right? There's, hundreds of them trying to jump in the space and buy up Amazon businesses and be the next, Thras. Not everybody's going to succeed. There's going to be failures there, and that's going to lead to consolidation. So, Thras may buy them up, or Razor might buy them up, or Branded or Elevate. Somebody else just might buy up those other assets that, these folks failed to, grow. I think part of the biggest challenge is for the aggregators is A, finding deals, and then B, actually operating them. If you go way back to what I would call the incubation of the aggregators, there's a little company called 101 Commerce, and a guy named Richard Jolly Chandra launched that. And the goal was to buy 101 Amazon businesses in 24 months. And the unwritten part of that was, and he told me this, he's like, first when he called me and told me this, I'm like, RJ, you're nuts. You're not going to buy that many. There's just not that many available. And this was, 6 years ago. And second, he said, and you know what, Joe? I'm not going to log into a single account during that entire period. I'm like, okay, you are going to fail, my friend. And he did. He sold to Goja. That's the problem, is the operator side, right? So, but the solution to that, Neil, is already coming to fruition, and that is Amazon agencies. So agencies like my Amazon guy, Steven, I'm sorry if you're listening. I can't. What's Steven's last name? He's a friend of mine. I'm so drawing a blank on this. Did I just have a whiskey or something? What's going on here, Neil?
You need more coffee.
I think that was a ginger ale.
I think what you meant to say was voltage, but that's okay. Go ahead.
Voltage, whatever it might be. Exactly. When you're running, an agency specific to, Amazon, you are primed to be acquired because they need you to operate these businesses.
They need operators. Them. Absolutely.
Right. And they may just acquire you and assign, 24 brands for you to manage. And then they may acquire someone else and assign 24 over there, and so on and so forth, or help you grow. That's what's going to happen next to some of these folks. There's no question about it.
No, and I agree, because we're in the operator space, which I'm joking. I don't mean to poke out your friend, Steve. But the the end result was obviously
there's plenty of people that can claim to be Amazon agencies. There's only a few that can do it well.
100%, right? I could show you across the board, having been in this for long enough, who is legitimately understanding an operation status. You could say, all right, operate a 6-figure year business on Amazon. Great. That's one very beginning level of operations on Amazon, right? It's until you reach the multi-40-foot container a month, until you reach the 8-figure mark, do you not truly understand what Amazon can do to you and how real operations actually operate against their practices and policies and what you think you can do.
I agree 100%. And given that I've done what I have done for a decade, and the conversations that I've had, 8,000 one-on-one conversation with Amazon entrepreneurs wanting to exit, Some of them have become, experts in the field of agencies, gurus, if you will. I've seen their P&Ls. They couldn't successfully run their own brands, so they ran others. You're not that guy. Steven's not that guy, but it's a shame that some are out there.
Oh, it is, and it's easy to find them. Go to YouTube and just start searching for Amazon FBA, and then look at anything between arbitrage, retail, wholesale, and then their moves to private label, and you'll find out very quickly that they have no experience in that. Just listen to the fact they never talk about true profits and what it takes to scale a business. You'll find out real fast. So the operational independence and upside potential, let's dig into that just a little bit, because I know those are components. Obviously, you mentioned documentation is the number one. My experience is those folks are not prepared to handle the upside. They're risk adverse to some degree. They don't maybe have the capitalization requirements necessary to hit the next tier. Let's get into the other couple topics, things that would be more specifically around what looks like a good exit. How would I know I'm in position to a good exit? Where do I need to be for Joe Valley to consider looking at my business for exit?
I'd want you to be at least 12 months old, so that we're looking at an exit at 24 months old. That's sort of the youngest in terms of age. We've sold a few in the 16 to 18 month old range, but you're going to be punished if you sell your business and it's only that old. Why? Because the younger it is, the higher the risk, the lower the multiple. So age is one thing. I like that 24-month mark, or I should say buyers have told us they won't require a discount at 24 months.
That's good feedback, because we typically say around 18, so we're not too far off.
Close.
It literally has to do, in my opinion, and you can obviously give yours, and we're sharing here, but it has to do with bottom line profits at the end of the day. As a buyer and someone who looks at businesses or manages businesses and to growth, it really gets down to the upside potential and the profitability of that business. If it is just requiring more inventory and capitalization, it's a great opportunity. If it's got some proven brand, if they're not attacking the market share, if they don't have additional channels open or even the opportunity for those channels, I always see great upside potential. And at 18 months, if they're not showing those signals, I think they're good acquisitions. What would you say?
18 months is the youngest that would go. I'd go 24, so that you could make sure you've got diversification in terms of SKUs. This is where you get into the growth. I love built-in paths to growth because buyers love built-in paths to growth. I sold a business, a privacy screen business several years ago. They had a total of 16 SKUs. 7 of them had been launched in the 6 months prior to me listing the business for sale. And those 7 were already representing 25% of the annual profits. That's huge, because all the buyer had to do was just let them age. So they're built-in paths to growth. And then the seller had identified, I think, another 32 potential, SKUs to be added in different screen sizes.
So we shoot for 10 to 15. And that's, sounds exactly like where you are and where I'm trying to help people get their mindset around that. In the first 12 months, we launched a minimum of 5 SKUs. And of that 5 SKUs, as well as I do, let's give the audience some understanding here. There's parent and variation SKUs, and different SKUs inside of Amazon are seen differently. So you could have, 12 variations of a product. They're all individual SKUs. So we're talking about, a parent relationship that has up to 100 SKU variations that haven't currently matured in the model yet. I see that, as the upside potential for certain brands, because most of the time, and I would say easily 70% of the time, these sellers don't have more than 5 SKUs in their brand. They're not even fully unlocking the potential of Amazon's marketplace for branding, because most of them do not have enough SKUs to show market maturity, especially even in Amazon's system. Would you agree with that? Would you disagree? Would you take us a different route?
I agree. No, I agree 100%.
Yeah. So we're pushing for like 10 to 15. So by the time you get to 18, you should have at least 20 SKUs, in my opinion, minimum, if you really want to see more than 3 to 4x. Is that a fair assessment for you too? Not just revenues, but in terms of multiples and exit multiples based on?
It depends upon the size of the business and the other factors, right? Risk, growth, transferability, documentation, but the size matters. A lot of buyers that are novice buyers will say, look, I'm just going to spend $100,000 because I don't want to take a whole lot of risk.
Yeah.
Well, that's the opposite of their goal.
Very much so.
The smaller the business, the less established it is. The less established, the higher the risk. So the multiple goes up in increments. So if it's less than 100,000, you're going to be, at a certain multiple, 100 to 500,000. And this is in discretionary earnings, by the way. When you get to 500 million, it bumps up again. When you get north of $1 million, it bumps up even further.
When you say discretionary earnings, for those who might not understand, what does that mean?
It's net income. When you run a profit and loss statement, it's that net income figure on the bottom of your P&L plus the add backs. Add backs, again, are owner benefits and one-time expenses that don't carry forward to the new owner of the business. An example would be, your owner's salary, single owner operator, or that cashback money we talked about. And, for anybody that's selling directly to an aggregator, they reached out to you, or you're selling directly to an aggregator. Do they have, Neil, does Thrasio already subscribe to Helium 10 and Jungle Scout?
As far as I know.
Right. How much is a monthly subscription to Helium 10 and Jungle Scout combined?
It's like sub $500.
Right. $500, $6,000 a year. Okay. So easy enough. If an aggregator wants to buy your business, Jungle Scout and Helium 10 are expenses that don't carry forward. Put them in the ad back schedule, and you just gained $18,000 to $24,000 on your list price. They cannot argue it. It's black and white math and logic.
Yeah. And for the My Network 6-leaf is the same, right? So for the tool we have, whatever you're paying per month for that and which tier you are, same thing. Seller discretionary earnings is what we're breaking down here, right?
Yes. So net income plus add backs equals seller's discretionary earnings.
There you go. Great combo. So as we kind of wrap this is great, man. I could keep doing this for another hour. You're a wealth of knowledge. And I'm trying to reiterate things that people who may be listening in My Network understand about where we're going and the value of what you're trying to understand. For those who might be considering getting involved in a business or even purchasing a business, might be listening to this. And we have a number of these that come across our desk all the time, as you know, and one recently was about 5.6 million in revenue. It looks really great, except you get down to the 4 SKUs making up all of that, which was a significant risk. The pushback was the idea that they didn't need to add additional SKUs in order to make that a good sale. That's not what I would say is a good value. And you've reiterated that here again today.
Yeah. And odds are of those 4 SKUs, one of them is representing 50% of the revenue, which is a hero SKU. And the buyers are all going to look for a discount on that.
It can be summarized like this. You want to make more money on Amazon. You want to sell for a higher exit. Put more SKUs in the system. And if you don't know how to do that, Joe's a good guy to talk about that. Joe, tell us a little bit more about what you're doing with your business right now and who you're looking for specifically that might be listening to this podcast.
Well, first of all, Quiet Light is, an M&A agency that helps people exit their online businesses. We're here to help. It's run by entrepreneurs. We've all built, bought, sold our own online businesses. And we've been in your shoes. So the first thing we're going to do is just help you understand the value of your business and what levers to pull or push to make it more valuable for your eventual exit. That is a cost of $0. We do it for free on the hopes and prayers that you see value in what we do. And when you do exit, you'll choose us. But I'll tell you right now, not everyone is comfortable talking to an advisor. So I took my decades worth of experience, my experience facilitating $500 million in exits, and I wrote a book that I launched last June. It's a best-selling book called The EXITpreneur's Playbook, How to Reverse Engineer Your Way to a Maximum Exit. And you can find that in the show notes. As we discussed earlier, I'm going to make a digital copy of it available. All they have to do is go to exitpreneur.io/voltage, and they can download the digital version of that book. They can still read it on the Kindle, Nook, iBook, whatever it might be. That's going to give them the entire path of what it's like to figure out that, hey, you do want to sell. Make sure you don't make the same mistakes I point out that some folks did. I changed the names of those folks. But everything that you need to know along the way from, I might want to sell this someday. What's it worth? How do I do the valuation? What's it like to list it? How do I negotiate with aggregators if you're going to do direct? What's due diligence? All of it. And I wrote it as if we were sitting across the bar from each other having a beer. So it should be something that's easily to digest and people can refer back to on a regular basis. exitpreneur.io/voltage.
Thanks for that, folks. If you are interested in learning how to build the businesses, go to voltagedm.com. Check it out. If you are ready to talk about how to exit, check out the link and check out Joe Valley. Joe, thanks for coming on today and answering some great questions. Appreciate you.
Thanks for having me.